What many are saying is the biggest financial crash that we'll see in years has begun. There are signs indicating just that. The cost of living has risen to new heights. Fuel prices are extremely high. The cost of goods have skyrocketed. And interest rates are through the roof. We have to look at one area that has taken a massive nosedive, which is the stock market. The overall stock market, according to Morningstar, has fallen 20%. S&P 500 has seen a similar plunge, with an 18% drop from its peak back in January. Billions in the stock market has been wiped out, and one of the industries that has taken the biggest hit was the tech industry. The biggest tech stocks in the industry has lost a combined $3 trillion within the last year. And yes, Microsoft, Amazon, Tesla, and even Apple have suffered massive losses in market value. There was a time years ago where investing in big tech companies like Microsoft and Apple were a safe haven, so to speak, to grow your bank account, or worst case scenario, to use as a hedge against other risky investments. But now, times have changed. In fact, a podcast episode from the Wall Street Journal, Your Money Briefing, emphasizes that bear market stock strategies, meaning investing in a Microsoft or an Apple, isn't going to work this time around. In fact, with the massive loss in market value with Meta Platforms, Alphabet, and Microsoft within the last year, betting it all in big tech would be very risky. Even the top billionaires in the world have seen huge portions of their wealth wiped out. According to Forbes, the world's richest tech billionaires have lost a combined $315 billion within the last year. Among those include Jeff Bezos, Larry Page, and Bill Gates, who lost 11 figures worth of their wealth. Then, among the 20 top billionaires in the world have lost a combined $500 billion within the last year. I don't know about you, but even losing $1 million would be extremely heartbreaking for most people, let alone over $50 billion that Jeff Bezos and Elon Musk lost alone. And again, the top billionaire Mongols had a huge portion of their wealth stripped because of the plunging stock prices, letting you know that the stock game, including in the tech industry, is a minefield. With events happening before our very eyes and behind the scenes, is why businesses may start making adjustments of their business operations. With the majority of CEOs in the stories shared by Yahoo preparing for a recession, around 81% of those CEOs say that the economy has gotten worse over the last 6 months. And 59% of those CEOs have said they're still dealing with the effects of the inflation, mentioning that input costs have increased or remained the same, which means the cost of overhead, from material costs to manufacturing costs, have gone up. And they still have to endure costs of maintaining their business operations, which includes paying their employees. And even though CEOs are preparing for a recession, some don't think this is going to be a short one. In fact, 13% of CEOs surveyed are preparing for a deep recession. So CEOs are getting ready for an upcoming recession. And so how they adjust will dictate that. One of those adjustments, which is the usual play for businesses, is to cut costs. One way of cutting costs is laying off employees. A survey indicates CEOs are planning to lay off staff, while also cutting back spending on environmental issues. CEOs cutting spending on environmental or social initiatives seems to be a short-term play. Most CEOs believe that an upcoming recession will affect their company's growth, thus the reason for the layoff plans. With major companies, including Netflix, Microsoft, and Tesla already initiating layoffs of staff. Meta and Google have initiated hiring freezes, while Gap and Wayfair also joined in the fray of laying off staff. CEOs have a lot on their plate, including many still navigating the aftermath of the pandemic, which causes disruption of supply chains and technology. This is to be expected given the events leading up to a recession. During the Great Recession of 2008, according to BetterUp, approximately 2.6 million Americans lost their jobs. Businesses can't sell their goods, especially if prices are too high, so they have to lay off staff. But on the flip side, businesses may spend more than they make, forcing them to cut costs. Unemployment during the Great Recession peaked over 10%, but persisted for quite some time. COVID-19 topped at 14.7%, but a lot of Americans bounced back quickly, part of that due to government intervention. This is the usual take on the vicious cycle of America's economy. And the laying off of staff will cause a dent on many Americans who need to make their mortgage payments. The US has seen mortgage rates climb past 7% for the first time in 20 years, meaning it's going to be a bigger challenge for many Americans to afford a house, especially since property values since the pandemic has increased by 40% within the past 2 years. Investors, already dealing with the stock plummets, were waiting to see what the Federal Reserve's next move would be. It didn't take long, as the Fed initiated another interest rate hike, adding another 0.75% rate, thus making it even harder for would-be homeowners to purchase a home. And the Fed may not let up soon. In December, we may see another interest rate hike to add to their 6th consecutive hike to the total of 4%. So homeowners who may need to sell may have a harder time doing so. That is until property values decrease. So a lot of would-be homeowners, until the real estate market shifts in their favor, may have to stick to or choose renting a place as an option. But renting poses a huge challenge as well, with rent prices exploding in the last 2 years, with Austin, Seattle, and Cincinnati seeing rent prices increase 30%. The Los Angeles median rent rate is $3,400 a month, while the state of Utah, Oregon, New Hampshire, and Illinois saw average rents jump from an average of $710 a month in 2021 to $1,535 in 2022. And in several other states, rents have jumped between 30 to 50% or more. Rents across the US have risen above $2,000 for the first time ever, and rent is on average 27.6% higher than it was back in 2020. Unfortunately, with the rising rent prices, it's put Americans in a feast or famine situation, with a list of the top 10 states where Americans are struggling the most to pay their rent. Just as CEOs are embracing change by cutting costs, Americans must embrace change by increasing their income potential. Many people know the middle class is disappearing, but with the cost of living rising throughout the nation, this begs the question, how much do you need to make to be considered middle class? Let's face it, most people are going to have a 9 to 5 as their primary or only income source, so it's best to find that out. Unsurprisingly, in San Francisco, California, you'll need to make 6 figures. Seattle isn't too far behind at over $110,000 annually, and then the remaining 4 cities, you need at least $80,000 or more in income annually. But if you want to set yourself up to have cash on hand to invest, purchase property, or cover unexpected costs, then making beyond the bare minimum required to make a living is the best option. So depending on your state, this is how much you need to make annually if you want to be considered rich. You can stop this video and rewind if you need to. If you ever find yourself looking for a new career, choose one that has the most stability. Not all job positions are created equal. Some are vulnerable to recessions, meaning that if you are currently working or plan to choose any of these industry fields, the chances of you getting laid off is higher. Instead, you want to choose one of these industries that is considered by gold banking rates recession-proof. Healthcare is great because people are always going to need health and medical assistance. COVID-19 proved that. Do more research on what field you want to get into. And if you're looking to one day become your own boss, look at working a 9 to 5 as a stepping stone to get you closer to your goals. Please like, comment, and subscribe for more content like this. Take care and see you in the next video.